If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Jerome Powell, Fed chief, has actually mentioned that they are open to higher and possibly faster US rate hikes.
As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated.
Now today in this discussion, I want to raise some points and show you some data. I'll also be going through some thoughts on banks, on REITs, and in particular oil. So if you're keen to find out these views, continue watching on. Hi guys, welcome back. Let's dive on to some charts. Fed actually controls the overnight borrowing costs, and the clearest impact on it is usually on the shorter term duration of treasuries. Let's use the US 2-year treasury. You realize that it's now broken new highs, correct? Right now clocking at 5.05% in terms of yield. This has smashed the previous high in October of about 4.7%. Take note again, the increment for the 2-year treasury yield has been very steep over the last 1 year. Previously, it was only at 1.5% thereabouts, and right now it's at 5.05%. The curious part at the start of this year, rates seem to be coming down a bit for the 2-year rate. You realize that it's actually tailed down towards 4.09%. And that's where everybody was rejoicing. I was also thinking, maybe that could be a reason as to why my own home loan rate has started to tail down a little bit. But what do we know? That was just only a small reprieve. And the direction again is up. Let's compare that against the US 10-year treasury. This paints a very different story. You realize that 10-year treasury has also inched up, but it has yet to break that October high. The climb over the last 1 year is not that steep. Previously it was sub 2%, but right now it's only at about 4%. So what can we guess from here? It is very likely that in some point in future, after 2 years, interest rates will indeed come down, correct? But you know, everything is focused on the short term. So if you look around in NASDAQ, which is very sensitive to interest rates, you realize that there is a strong negative correlation. This chart shows you the US 2-year treasury performance against NASDAQ. NASDAQ climbed at the start of 2023. That was because there was hope that rates will tail off and not climb any further. But what do we know? When rates started to climb, NASDAQ composite has yet again started to fall. I would maintain again that when it comes to investing, ignore the short-term noise. It's very unpredictable. You do not get an edge over there. All we will chatter about is recession risk, and not sure what to do instead. And why is recession risk always in the headlines? There's something called a yield inversion. This is something I've covered on the channel. But let's pull up a newest chart. This is a comparison between a 10-year rate and a 2-year rate. When you lend somebody money over 10 years, naturally you expect higher interest rate, correct? But as I've shared just now, the 2-year rates have been climbing very steep, but the 10-year rates have not. That has led to this yield inversion, whereby right now you see that this phenomenon has lasted for 6 months already and is right now more than 1% in terms of difference between 2 years and 10 years. It means also when you lend monies for 2 years, you get 1% more than 10 years. That is what it means. But again, after 2 years, you have reinvestment risk. This phenomenon is not yet observed for the last 20 to 30 years. You realize that anytime the yield inversion happened, a recession tended to take place in the next 6 to 9 months. That is depicted in the shaded grey area over there. It happened after the dot-com bubble in 2000. It happened after the global financial crisis in 2007. But again, it's never fallen to a point whereby the 2-year yield was 1% more than a 10-year yield. So indeed, we are in uncharted territories. My guess to this phenomenon is that, in the periods of 2010 to 2018, governments have kept interest rates way too low, and that's why the 2-year rates were also suppressed. In this 8 to 10 year period, there could have been a lot of excesses, especially in real estate and technology. That, in my guess, is why it's taking so hard to flush out the monies from the system. So again, we are in uncharted territories, and the main point about companies right now is that they need to turn profitable because borrowing cost is getting very expensive in the near term. That is a reason why companies like Sea Limited have pivoted very aggressively to turn profitable. They have managed to do so in 4th quarter 2022, and they have recorded their first profit. If you've been trading on markets, you see that Sea Limited has jumped up by 20%. I just want to cover on them in a quick while, because what I realized in this statement is mentioned that this profitable quarter was partly due to debt extinguishment, reversal of previous accruals for certain expenses, and aggressive cost cutting and layoffs over the past 1 year. How are these measures sustainable? And when it comes to investing, we need to have a good sense on how to accurately forecast what is the profitability like in the next 1, 2 or even 5 years. These are short-term measures just to squeeze down expenses, which is important now, but also is likely not sustainable. At least C Limited has turned profitable. There are still many small tech players and many SaaS players that have yet to turn profitable. They are in big trouble because to borrow money for 2 years, you need to pay 5% now at least. And when you're unprofitable, you are very reliant on debt to survive. Many of the tech players came from a previous hype, which include sharing economy, e-commerce, cloud-based computing, which is no longer sexy because the hottest name in the market is AI. All the hot money is likely going towards AI because we've seen the revolution that ChatGPT has provided. I've seen teachers talking about it, I've seen doctors talking about it, and for a tech startup not in this space, it's going to be increasingly hard to attract new monies. Now let's pivot to something I've covered a lot recently, REITs. Some of you may have bought REITs also, and let me reassure you that REITs in my view are okay. Unless you are investing into Lipo Mall Indonesia REIT where the interest cover ratio is only 2.32 times, and there's so much debt maturing in 2024. I've actually pushed back my REIT video, so if you're looking for more insights, do remember to subscribe. And it's not just REITs actually. Any well-capitalized, cash-generating business is generally okay. The only question for these businesses is how to deliver growth. That in itself is not easy, but when it comes to debt management, we can see things like this. This is actually from Ascendus. It's mentioned that they have proactively refinanced their debt and spaced it out over the next 5 to 10 years. Within a particular year, there's less than 20% up for refinancing. In a simplistic term, they follow the yield curve a bit more of the 5 or 10 year US Treasury, and at some point when interest rates come down, they can always refinance to lower cost. So again, it's not Fed funds rate go up by 50 basis points, interest costs in REITs go up by 50 basis points. It's not true. A lot is long dated. Then what about for banks? I think if we see over here in this article again, Fed has projected in December that rates will rise to 5 to 5.25%. Mr. Powell has suggested that peak rate would need to be adjusted by more than that without specifying how much. Now this should be music to the ears. When I look to DBS's books, CEO PH Gupta has once mentioned 4.75% in their description of profitability. If overnight lending rates are at least 5.25%, I think banks will likely be more profitable in 2023 than in 2022. The peak is definitely somewhere further down only for them. Then what about for big oil? Realize that this is a typical industry which is very cash generating. Big oil includes Exxon, Shell, Chevron. Big oil has more than doubled its profits in 2022 to $219 billion. Now with China reopening, I do believe that big oil is a beneficiary. Oil prices have always been fearful of a recession. But these oil giants are already so profitable with oil only at $80. What if there's no deep recession that will suppress demand? And with China reopening, there is every indication that oil prices could inch up yet again. Even seen on certain opportunities on oil, let me invite you to some of my previous tutorials. My commodity videos are always an acquired taste. If you're keen to find a bit better in that space, I think I've shared quite a bit more. Let me invite you there and sign up from here. Take care as always, goodbye.